Welcome to our quarterly strategy update. 3 months into the year, and after a long hiatus, volatility has returned to the market in a big way. In fact, with the quarter just ended, it marked the first quarterly loss for the S&P in 2 years. Now, in keeping with the Superman Clark Kent theme that we employed at the beginning of the year for our outlook for the entire year, the title of this second quarter strategy is Kryptonite. Now, the kryptonite use, as you may recall, we used in the first outlook for the year as a metaphor for what we thought was the biggest risk to our constructive outlook for capital markets, namely persistently high inflation. Inflation has proved to be persistently high. Not only that, but the situation got even more complex with the recent brutal and shocking invasion of Ukraine by Russia. Historically, investors don't like uncertainty, and it was no exception here with the invasion of Ukraine. The initial reaction was to sell equities, reduce assets, go to safe havens such as cash. Well, as you can see in the table here, we've taken a look back historically at previous sort of geopolitical events of the past generation, and the behavior's been very consistent. Notice the red column in the middle there. That's the investor reaction. Initially, the market has sold off between 5 and 25%. But the thing to remember is what drives markets over the long term is not headlines, but it's economic underpinnings. In other words, the financial realities of the landscape. And the fact is here, as you can see in the green, 6 months after every one of these hostilities began, the market was up. It was up between 7 and almost 30%. And that's been the case so far here. Initially, the market sold off with the invasion of Ukraine, and as we stand before you today, the market is actually higher than it was when the hostilities began. Now, the economic consequence of the invasion is clearly well documented that it's going to make inflation much more pervasive, not only here, but in other parts of the world as well, as the energy complex becomes very disrupted. As you can see here, this sort of tightrope, that represents the Federal Reserve, because really what it's done is it's made the Fed's job much more difficult as they're trying to slow the pace of economic growth, to tame inflation without tipping the economy into recession. It's a balancing act. The expectation is the Fed will raise rates a quarter point 6 more times this year, taking Fed funds to about 2%, and perhaps 4 more quarter point hikes next year. We'll see. The Ukraine invasion has softened the Fed's hawkish stance, and they'll obviously be very data dependent as to how quickly they raise rates. But again, it's a very difficult sort of tightrope they'll have to walk, more difficult than it was 2 months ago before the invasion. As far as inflation, our outlook at the beginning of the year was for what was then headline CPI, Consumer Price Index, that was around 7%, to slowly recede down to towards 3% by the year end. Our expectation is still for 3% inflation longer term, but we think rather than getting there by the end of this year, it will take to the end of next year, because the forces of a less accommodative Fed, of a healing labor market, of a reopening from COVID, of supply chains being repaired, all these things are still going to happen, but it's going to take longer than previously thought. Now, with the Fed tightening, the question we're getting most frequently from clients is, well, does that mean that the economic cycle's over and the bull market's over for stocks? Historically, the answer is no. As you can see in the table here, we've taken a look at past cycles of Fed tightening since the early 80s and seeing how the market has behaved 3 months, 6 months, and 12 months after the first rate hike. Now remember, the Fed raises rates when the economy is strong. They're trying to slow it down. They're trying to keep inflation under control. So it's a strong economy, and that's the case here. As you see in the table, 3 months after the first rate hike, the market's been up about 3%, 6 months over 7%, and a year later, the market's been up over 10% on average. So again, this does not mark the end of an economic cycle or the end of a bull market historically. Each cycle's different, but the economy's in strong footing in our view. And to that end, fundamentals matter, as we indicated. Ultimately, earnings are what drive stocks. And despite the fact that consumer confidence has waned in recent months, despite the fact that we have the Ukraine inflation and stubbornly high inflation, earnings expectations in the last 3 months have actually gone up. As you can see here, S&P earnings last year were $206. On January 1st, the expectations were for the S&P to earn $221, a growth of 7%. Now, the expectations are for S&P earnings of $228 in 2022, a growth rate of not 7%, but 10%. As far as the underlying economy and the health of the economy, one need look no further than the health of the consumer. After all, the consumer is 70% of the economy. If you're to take a look at one indicator of the consumer and how healthy are they, you'd take a look at whether they're employed. And here you see the unemployment rate now down to 3.8%, down to pre-pandemic levels and within striking distance of 50-year lows. The consumer's employed. The consumer has $2 trillion in savings. The consumer is enjoying wage growth that they haven't seen in 20 years. And they have the highest household net worth that they've ever had. So this isn't a backdrop that would indicate that a recession is imminent. The consumer is very healthy, and we think this cycle still has legs. Now, as far as portfolio impacts of the Ukraine invasion, here we have tried to indicate what we think are winners and losers, and we've color-coded things based on, in green, whether we're overweight that sector, red, whether we're underweight, and gray, whether we're neutral. The winners, of course, are energy. Obviously, it's well documented that energy prices have spiked. We're neutral energy, so we've been fully participating there. But the real winners in terms of an asset class, and the only asset class that has a positive return so far this year, are alternatives. Agricultural property, timberland, infrastructure, the things that we've been doing with our allocation to the Versus funds. Those are actually up this year. Also, defense stocks, we're slightly overweight there. We think that with the Ukraine issue, that defense spending is going to be a secular sort of theme that's investable. As far as losers, number one, the consumer, we're neutral there, and Europe's the biggest loser. Inflationary pressures and fallout, they're much more reliant on Russian energy and inflationary pressures and growth that will be impaired due to what's happening there. It's going to be really felt in Europe. There may be even some countries that go into recession in Europe this year. We've been underweight Europe. We continue to be underweight there. And international equities as a whole, we're neutral. We think the U.S. is going to be a better economy. That sort of flight to quality helps the dollar, which makes international investing more difficult. So we like our posture right now. In summary, we believe investors are going to correctly look beyond the Ukrainian crisis headlines and look to the underlying fundamentals, which remain strong for the U.S. economy, strong for the U.S. consumer. Clearly, the challenge of the Fed is more difficult for them to raise rates without tipping us into recession. They'll be very careful not to do that. We'll see how that goes on a month-to-month basis. Our current allocation, which has a minimum weighting to bonds and leans into alternatives and equity investments, we believe will continue to be rewarding as the year progresses. Thank you so much for your time. Be well, and we look forward to connecting with you in the summer. Cheers.